Hi, I'm Nicole Maulion, and this is the special role of commercial banks. Commercial banks, financial institutions that provide finance and investing services for businesses. Commercial banks acts as a storehouse of the country or region's wealth. The primary role of commercial banks in the developed world is to offer business bank accounts with standard options such as deposits, withdrawals, and loans. A secondary role of commercial banks is supporting the development of the local economy. Collectively, commercial banks act as a storehouse of the country or region's wealth. The banks take care of funds that were deposited by clients into their business bank accounts. The banks invest the money to generate interest for their clients and to maximize the bank's profits. Commercial banks balance sheet. Commercial bank's balance sheet has two main sides, the liabilities and the assets. From the study of the balance sheet of a bank, we come to know about a system which a bank has followed for raising funds and allocation of these funds in different asset categories. Liabilities. A. Share capital. B. Reserve funds. C. Deposits. Fixed deposits, savings deposits, current deposits, and other deposits. D. Borrowing. E. Other liabilities. Assets. A. Cash in hand. Cash with the central bank. Cash with the other banks. B. Money at short. C. Bills and securities discounted. D. Investment of bank. E. Loans and advances given. F. Other assets. Banks' liabilities constitute 5 major items. Share capital. The contribution which shareholders have contributed for starting the bank. 2. Reserve funds are the money which the bank has to accumulate over the years from its undistributed profits. 3. Deposits are the money owned by customers and therefore it is a liability of a bank. There can be various kinds of deposits and recurring deposits. Apart from these items, a bank can borrow from central and other commercial banks. These borrowings are also treated as banks' liabilities. Banks' assets comprises cash, money at short notice, bills and securities discounted, banks' investments, loans sanctioned by the bank, etc. Payment and system and money. Banks have developed various payment methods to facilitate the exchange of money that stimulates the growth of commerce, helps economic development, and facilitates flexibility with lower transaction costs with security. Various payment systems exist today, ranging from check, wire transfer, cards to online transfer. Payment system is a mechanism that facilitates the transfer of value between a payer and beneficiary by which the payer discharges the payment obligations to the beneficiary. Payment systems are the medium to transfer funds from one person to another that facilitate businesses and economies. The payment system enables a two-way flow of payments in exchange for goods and services in the economy. Payment systems help consumers to transfer funds to each other. Cash is the traditional and most widely used payment instrument that consumers use in their daily lives to purchase goods and services. Banking channels also provide other payment instruments through different platforms, and these are also widely used in commerce. Payment systems comprise of instruments through which payments can be made. Rules, regulations, and procedures that guide these payments institutions which facilitate payment mechanisms and legal systems that are established to facilitate the transfer of funds between different participant institutions. Payment systems are used by individuals, banks, companies, governments, etc. to make payments to one another. Classifications of payment methods. 1. Large value payment system. 2. Retail payment system. Cash payment, paper-based payments, card-based payments, electronic payments, and remittances. One, interbank checks clearing system, the interbank clearing. 2. High value checks clearing system, the high value clearing. 3. Government securities clearing system, the GSEC clearing. 4. Foreign exchange clearing system, the Forex clearing. 5. Real-time gross settlement, RTGS system. Retail payment system. 1. Cash payment, paper-based payment, checks, demand drafts, payment order or banker's checks. Card-based payments. 1. Credit card, debit card. 4. Electronic payments and remittances. Electric clearing services, electronic funds transfer, real-time gross settlement, internet banking, mobile banking. Liquidity provision. Liquidity of banks is the case with which bank's asset could easily be converted into cash. The liquid assets include cash in bank vaults and other government securities that have not been used as collateral for loans. The most liquid of all these assets is cash. Liquidity management involves provision for depositors, withdrawals, and short-term cash requirements. It also involves the provisions to meet legal services requirements and for the cyclical and secure cash requirements. Liquidity of banks is the case with which bank asset could easily be converted into cash. The liquid assets include cash in bank vaults and other government securities that have not been used as collateral for loans. The most liquid of all these assets is cash. These are many reasons why a bank should have reasonable liquid assets in its assets portfolio. This includes, amongst other, to bubble the bank to meet prompt demands from deposits and to ensure that the bank maintains public confidence, and also be able to utilize profitable opportunities that may come out in the future. However, it should be mentioned that banks, like most other businesses, are profit-oriented. They operate in order to make profit for their shareholders. The profits could duly be realized only if there is adequate deposits from bank customers. The deposits will not come unless the depositors could be assured of the safety of their deposits, and for the safety of the deposits to be assured, this has to be enough liquidity in the bank. Conversely, a bank operates in order to make profit for his or her. Shareholders, it is known fact that action designed to make profit in banks may bring about bank distress and vice versa. Therefore, equilibrium has to be sought between the two. These taken extreme cases have been the constant concern of bank management. Liquidity management involves provision for depositors' withdrawals and short-term cash requirements. It also involves the provision to meet legal reserves requirements and for the cyclical and secure cash requirement. This is usually the case in the sale of an item. For example, if a homeowner wanted to sell their house, they would have more information about the house than the buyer. They might know some floorboards are creaky, the home gets too cold in winter, or that the neighbors are too loud. Information that the buyer would not know until after they purchase the house. The buyer then might feel they paid too much for the house or would not have purchased it at all if they had this information beforehand. Dealing with asymmetric information. Asymmetric information can also be viewed as the specialization and division of knowledge as applied to any economic trade. For example, the doctors typically know more about medical practices than their patients. After all, physicians have extensive medical school education backgrounds that their patients generally don't have. This principle equally applies to architects, teachers, police officers, attorneys, engineers, fitness instructors, and other trained professionals. Asymmetric formation, therefore, is most often beneficial to an economy and society in increasing efficiency.
Okay, good luck po, mga senyores.
Understanding asymmetric information. Asymmetric information exists in certain deals with the seller and buyer whereby one party is able to take advantage of another. Advantages and disadvantages of asymmetric information. Advantages. Asymmetric information is not necessarily a bad thing. In fact, growing asymmetrical information is the desired outcome of healthy market economy. As workers strive to become increasingly specialized in their chosen fields, they become more productive and can consequently provide great value to workers in other fields. Disadvantages. In some circumstances, asymmetric information may have near fraudulent consequences such as adverse selection, which describes a phenomenon where an insurance company encounters the probability of extreme loss due to a risk that was not divulged at the time of policy sales. For example, if the insured hides the fact that they are heavy smoker and frequently engage in dangerous recreational activities, this asymmetrical flow of information constitutes adverse selection and could raise insurance premiums for all customers, forcing the healthy to withdraw. The solution is for life insurance providers to perform thorough actuarial work and conduct detailed health screenings, and then charge different premiums to customers based on their honestly disclosed risk profiles. Maturity transformation. Despite all the furor that surrounded the sector recently, retail banks perform a vital role in an economy. They take short-term sources of finance, such as deposits from savers and money market loans, and turn them into long-term borrowings, such as mortgages. This is called maturity transformation, a rather grand way of saying that they exist to meet the needs of lenders and borrowers. In return for providing this service, they make money by charging more for a loan than they offer to pay on, say, a deposit. However,